We often read quotes like this one from Peter Lynch, where he says, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Here are revenue, net income, and growth metrics for a company from Q3 2003 to Q2 2004. The information for each quarter, kind of runs horizontally. If you look at the bottom row at Q2 2004, across the top column, you see the trailing 12-month revenue, trailing net income, trailing quarter-over-quarter revenue growth, year-over-year net income growth. Again, this is a real example. These are the real numbers. During this time period, this company here is a microcap company. It created its niche and its category. As you can see, revenue and net income, it looks like the growth is continuing to accelerate. Now, I could also give you the balance sheet. I could also give you the cash flow statement, which are obviously very important. But for the sake of time, let's just say that they are what you would expect and there are no red flags. So given what you see here, by a show of hands, how many people would be interested in owning this company? Okay, quite a few. Now, it's probably actually a hard question to answer because I didn't tell you what the valuation of this company is. So let's just say that this company is trading at a 10 PE. How many people here would own this company at a 10 PE? Come on, everybody's hands here should be raised. Paul obviously hasn't taught you anything here, if they aren't. Okay, now how many people would own this at a 20 PE? How many would own this at a 30 PE? Okay, we still have quite a few hands raised. What if I told you, and this is a real story, so what I'm telling you is real, that during Q2 2004, so the last period shown here on this slide, what if I told you that the two largest industry players, one's an 80 billion market cap company, one's a 110 billion market cap company, took notice of the category that this small company created and decided to launch their own products into the market? Both of these behemoths have global distribution systems, and they intend to spend tens of millions of dollars in marketing to take market share. So given this new information, how many of you would still own this company? Okay, quite a few less. Now, what if I told you, and this is real, that at the same time that these two industry behemoths announced plans to enter the market, that the CEO and the COO of this small company sold 26% of their holdings? So, just in review, we have a company that's a microcap. It's growing revenues 40% per year. Net income is growing 267% year over year. The growth looks to be accelerating. The company is trading at a 30 PE. Two of the industry's largest competitors have taken notice and are entering the market. The CEO and the COO just sold a quarter of their position. How many of you would own this company? I don't know if I would. And, by the judge of it, not many of you would as well. Well, you would have missed out on a 140 bagger because this company is Monster Beverage. We actually wrote a whole case study on Monster Beverage on intelligentfanatics.com. In the case study, we take you through the entire history of the company from a stock valuation and competitive situation. Reading through the history of Monster Beverage just reinforces how hard investing can be. Investing is hard for a variety of reasons. Some of the reasons are outside our control, but many of them are totally within our control. Oftentimes, it's our human nature that gets us into trouble. Successful investing is counterintuitive to our human nature. It's a lifelong process of retraining our minds to think different and better. I've been investing now for close to 20 years. I've been a full-time private investor, exclusively investing in microcaps for a little over 10 years. I feel I've been lucky because I'm old enough to have emotionally invested through 2 bear markets, but I'm still young enough to hopefully benefit from those lessons that I've learned. And I'd like to share a few of those lessons with you this morning. When you are trying to find great businesses early, intelligent fanatics early, before the inflection point, before it's obvious in the financials, there are a lot of moving parts. These companies are small and evolving. There's a lot of imperfect information that you are collecting. You aren't going to be right all the time, and you need to accept this. We often read quotes like this one from Peter Lynch, where he says, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. I think we oftentimes read this and we nod our heads in affirmation, but deep down we think we can be right all the time. We think that the search for perfection makes us better. Well, I don't think it necessarily does. When you're investing in small microcap companies around an inflection point, you're simply looking for signs of greatness. The businesses might evolve the way you think, or they might not evolve at all. It's not batting average that is important. It's slugging percentage. Your success or failure as a microcap investor will be decided by how quickly you cut your losers and how fast you lean in and own more of your winners. When I was younger, I would immediately take large positions. If I liked something, I'd go all in right away. I was fearless. And this strategy works until it doesn't. I got lucky a little bit in my early years because it worked a few times in a row. But what I found out is you don't need to bet the farm right away. You have time. That's the great thing about microcaps. There's a long way to go to the upside if management continues to execute. So let management prove themselves to you before you own more. Let me ask you a question. How many companies have you owned where you genuinely like them more 1, 2, 3 years later? How many companies have you owned where you genuinely like them more a few years later? I think if we're all being honest with ourselves, the answer to that is not very many. And I think that's just proof that you need to weight your position sizing in the beginning accordingly. I like to buy about 1/3 of my position in the beginning, then I buy more as management executes. The best ones are the companies I'm continuously averaging up in. I think one of the most misused quotes of Warren Buffett is our favorite holding period is forever. He didn't mean that every stock should be held forever. He certainly wasn't talking about most microcaps. Holding forever only works when management executes forever. And so my holding philosophy is quite simple. I hold as long as management executes. And to do so, you need to understand the businesses you invest in on almost a personal level. I find that too many investors stay trapped to their offices and strapped to their chairs evaluating businesses on Excel spreadsheets. Businesses are not Excel spreadsheets. Businesses are people. Let me give you sort of a due diligence hack. 95% of due diligence is analyzing if customers and employees are happy and why. Your edge is that 95% of investors will not do this. If you want above average returns, you need to do what average investors aren't willing to do. Due diligence doesn't end after you buy your shares or you make your initial investment. Buy and hold isn't buy and forget. You need to buy and verify your thesis, and the smaller the company, the more often you verify. The only thing more important than having a great investment thesis is knowing what will kill your investment thesis and having the decisiveness to act. Write down a list of what will kill your thesis. This might sound counterintuitive, but if you are truly prepared, then you should be prepared to be wrong. What I do with every position is try to develop contact points through my scuttlebutt research to gauge industry and company optics and data points. I'm still a full-time investor today, not because of my gains, but because of the losses I didn't take. One of the biggest mistakes investors make is selling their winners and buying more of their losers. If anything, you should be doing the opposite of that. Unfortunately, but over the last 20 years, history has taught me that visionary leadership that executes is rare. Always own more of the management teams that have shown a history of executing. I know Paul also likes this quote here, and this is a quote from Bill O'Neill. Take your losses quickly and your profits slowly, because your objective is not just to be right, but to make big money when you are right. The final point I'd like to make this morning is do the work. Don't bother finding the next multi-bagger if you aren't going to develop the conviction to hold it. You can borrow someone else's stock ideas, but you can't borrow their conviction. True conviction can only be obtained by trusting your own research over that of others. And I think Paul and Brandon here today would agree with this. Their job is to show you ideas and why they like them. They aren't going to be right all the time. It's your job to put in the work and decide for yourself what to do. When you blame others for your investing mistakes, it proves you didn't do enough of your own work. So in conclusion, investing is hard, but it's also a whole lot of fun. You only have to find a few great investments early to beat the market and to change your life. Do the work, wait for your pitch, and swing hard. Thank you.